An investment portfolio can contain stocks, bonds, commodities, cash, and cash equivalents. Traditionally, a balanced portfolio is believed to have stocks, bonds and cash equivalents. But now, year 2021, holding cash or cash equivalents may not be a good idea. In fact, many have started to include cryptocurrency as part of their portfolio. Is that a good idea? Well, only time will tell. Generally, a good portfolio tends to be diversified, and consists of assets that are not highly correlated. Diversification can lower the risk without lowering the portfolio's expected rate of return. Note that diversification is the only free lunch in finance. The expected rate of return of a portfolio is often calculated by weighting each individual investment's expected rate of return, using the fraction of the portfolio that is invested in each investment. The formula looks like this. Let's apply the previous formula on an example. If you invest 25% of your money in the stock of Citibank with an expected rate of return of -32%, and 75% of your money in the stock of Apple with an expected rate of return of 120%, what will be the expected rate of return on this portfolio? Let's take a look at the previous formula. Just plug in the numbers in the formula. The expected rate of return is equals to the weighted average of the returns, which is 82%. Let's go through another example. Consider a portfolio with 3 assets: T-bills, ULA Bank and Starbucks. The portfolio weights unexpected returns are listed on the right side of the assets. Given your portfolio allocation, what rate of return should you expect to receive on the portfolio? Keep the previous formula at the back of your head. Go through table, and start plugging the numbers into the formula. You will get an expected rate of return of 7%. The expected rate of return on a portfolio is a weighted average of the expected rate of return on each asset in the portfolio. Can the same approach be used to evaluate portfolio risk or standard deviation? The answer is no. Risk is measured using standard deviation. Weighted average of the standard deviations of the returns of portfolio assets would not work because of the so-called diversification effect. Based on the diversification effect, the outcome of a diversification depends on the degree of correlation among the assets in the portfolio. The level of benefit we can get from diversification depends on the degree of correlation among the returns of the assets within the portfolio. The degree of correlation is measured by using the so-called correlation coefficient. The correlation coefficient ranges from -1 to +1. Imagine that there are 2 assets, A and B, in a portfolio. -1 represents a perfect negative correlation, which means both A and B move in perfectly opposite directions. Plus 1 represents a perfect positive correlation, which means both A and B move exactly together. 0 represents no relationship between the returns earned by A and B. There will be diversification benefit as long as the returns of portfolio assets are not perfectly positively correlated. Diversification works best when the correlations are low or negative. Portfolio risk or standard deviation can be reduced by combining assets with returns that do not move together. Let's take a look at how standard deviation is calculated. Sigma portfolio is the standard deviation of the portfolio's returns. Wi is the weighting of asset I in the portfolio. Sigma I is the standard deviation of asset I's return. Rho 1, 2 is the correlation coefficient of the returns by asset 1 and 2. Let's go through the formula with an example. Determine the expected return and standard deviation of a portfolio with two stocks, Apple and Coca-Cola. The correlation coefficient of the two stocks is 0.75. Based on the formulas you learned in the previous slides, you can calculate the expected return and standard deviation of the portfolio. The expected return of the portfolio is 14%. The standard deviation of the portfolio is 18.7%. Based on the previous example, let's change the correlation coefficient, and see what we get. If the correlation coefficient is -1, the standard deviation becomes 0%, which means there is no risk in the portfolio. In other words, maximum benefit from diversification. If the correlation coefficient is 0, the standard deviation becomes 14.14%, which means there is approximately 14% risk in the portfolio. A substantial benefit from diversification. Now, if the correlation coefficient is +1, the standard deviation becomes 20%, which means there is a 20% risk in the portfolio. This is equal to the standard deviation for each individual stock. In other words, diversification provides no benefit at all. An investment portfolio is exposed to both systematic risk and unsystematic risk. The systematic risk, also known as undiversifiable risk or market risk, measures the contribution of an investment to the risk of the market. A systematic risk is a risk that cannot be avoided. Some common examples of systematic risk are the war against terror in the Middle East, and the recent military coup in Myanmar. The unsystematic risk, also known as diversifiable risk, non-systematic risk or specific risk, is the element of risk that does not contribute to the risk of the market. Such risk can be diversified away by adding other investment components into the portfolio. Some examples of unsystematic risk are recall of faulty airbags by Takeda, labor strike in Europe, and the change of top management at Amazon. The graph shows how the number of stocks affects the risk or standard deviation of a given portfolio. The red line represents the systematic risk. No matter how many stocks are added to the portfolio, this risk remains intact. It cannot be removed. The green line represents the unsystematic risk. As more stocks are added to the portfolio, the risk or standard deviation goes down, closer to the horizontal line, that is, closer to the systematic risk. The orange line represents the total risk, which is systematic risk plus unsystematic risk. From the previous graph, we can see that as the number of stocks in a portfolio increases, the contribution of the unsystematic or diversifiable risk to the standard deviation of the portfolio declines. The systematic or non-diversifiable risk is not reduced even as we increase the number of stocks in the portfolio. Systematic sources of risk are common to most investments, resulting in a perfect positive correlation, and no diversification benefit. A large portfolio will not be affected by unsystematic risk, but will be influenced by systematic risk. This is because a large portfolio would have enough stocks to diversify away almost all of the unsystematic risk. Systematic risk is measured by the so-called beta coefficient, which estimates the extent to which a particular investment's returns vary with the returns on the market portfolio. Thank you for watching.